A few hours ago, the Federal Reserve did something that has not happened in a long time, and almost nobody is explaining what it really means for the metal in your safe. They held interest rates steady, exactly as the crowd expected, but 3 members of the committee broke ranks. 3 of them refused to go along, dissented openly, and demanded that rates be raised instead. And within minutes of that news crossing the wire, the stock market dropped more than 1%. I am here to tell you that the headline everyone is reading, "The Fed held rates," is not the story. The story is the crack that just opened inside the most powerful financial institution on earth. And by the end of this video, you are going to understand why a divided Fed is far more dangerous and far more important for anyone who owns gold or silver than a united one ever could be. Stay with me, because this is the detail that separates the people who understand this market from the people who only watch the headline. And here is the twist, the part I want to hand you right now instead of making you wait, because it changes how you hear everything else. When a central bank speaks with one voice, the market feels safe because it believes someone is in control, someone knows the plan. But when 3 members of that committee stand up and openly declare that the chairman is making a mistake, that they want to go the other way, the market hears something it fears far more than any single decision. It hears uncertainty at the very top. It hears that even the people in the room cannot agree on what happens next. And gold, throughout all of history, is the asset that wakes up precisely when confidence in the people steering the ship begins to wobble. The dissent you just witnessed is not a footnote. It is a flare fired from inside the building, and it is telling you the calm you have been told to expect is not as solid as it looks. But before I go further, I want to know who is in the room with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly what you are holding. Gold, silver, cash, waiting on the sidelines, tell me, because I read these, and the mix of answers in the hours after a Fed decision tells its own story about who is calm and who is rattled. And I promise you, I will come back to what those answers mean before we are done. Let us start with the machine at the center of it, because you cannot understand the crack without understanding the lever. The Federal Reserve's single most powerful tool is the interest rate, the price of money itself. When they raise it, borrowing gets more expensive, saving gets rewarded, money grows scarce across the whole economy. When they lower it, money turns cheap and plentiful. And this one, lever, more than almost anything else on earth, governs the fate of gold and silver for a reason you must hold on to if you are to understand anything about this market. Gold and silver pay you nothing. They earn no interest, no dividend. They simply sit there. So when interest rates are high, holding metal carries a hidden cost, because every dollar sitting in gold is a dollar not earning that attractive interest somewhere else. Economists call it opportunity cost, and it is the invisible weight that presses down on gold whenever rates rise or are even expected to rise. But when rates fall or are expected to fall, that weight lifts. The bond paying almost nothing looks no better than the metal paying nothing. And gold, freed of its disadvantage, tends to climb. Rate expectations up, gold pressured. Rate expectations down, gold released. That seesaw is the beating heart of this entire market, and almost everything else is noise laid on top of it. Now, here is why today's dissent matters so much, and why it is not just political drama inside a marble building. Those 3 members who wanted to raise rates are the hawks, the ones most afraid of inflation, the ones who look at the surging price of oil and the ongoing conflict overseas and conclude the Fed must act harder to keep prices under control. The chairman held them off this time. But their open revolt is a signal flashing bright that the pressure to raise rates further is building inside the committee, not fading. And rising pressure to raise rates is exactly the weight that has been pressing gold down all year. The dissent is the market's warning that this weight is not going away. It may be about to get heavier. If you are finding this useful already, take a moment to like this video and subscribe. Because now I need to tell you about the man at the center of this storm and about the strange and revealing thing he did that makes today's split even more significant than it appears. The chairman running the Federal Reserve right now is known throughout his career as a hawk himself, someone deeply focused on stamping out inflation, someone who has said plainly that he has no tolerance for it and that it remains too high. So here's the puzzle. If the chairman is a hawk and three other hawks wanted to raise rates today, why did the Fed hold steady instead of hiking? The answer reveals the tightrope this man is walking, and it is the key to everything. He is caught between two forces pulling in opposite directions. On one side, the inflation hawks, including himself by instinct, who want to raise rates to crush rising prices. On the other side, an economy showing signs of strain, a softening job market, and a mountain of government debt that becomes more crushing every time rates go up. He held today not because the pressure to hike is gone, but because he is trying to balance on a wire between these forces, and the three dissents are proof of just how much that wire is shaking. And there is one more detail that makes this chairman, and this moment, so charged. At his first meeting in charge, when every member of the committee was asked to privately write down where they expect rates to go, he declined to submit his own projection. He left it blank. The single most important voice in the room withheld his own forecast. A quiet admission that even he is genuinely uncertain about the path ahead. Think about what that means alongside today's dissent. You have a chairman who will not tell you where he stands and a committee openly fracturing beneath him. That is not a picture of calm control. That is a picture of an institution genuinely unsure of its own next step. And that uncertainty, more than any single decision, is what gold responds to. Let me make this real with two people, because these forces only matter when you see how they land in an actual life. Neither is real, but both are the kind of person you might recognize, perhaps in the mirror. The first I will call Walter, 69, retired. And Walter did what a huge number of people did today. He read the headline. The Fed held rates, and he relaxed. Nothing happened. He told himself the storm passed, and because he only read the headline, he completely missed the three dissents buried beneath it. The crack that actually matters. Walter reacts to what is loud and obvious, and he misses what is quiet and important. And it is a pattern that has cost him again and again. He hears the all clear and never notices the alarm ringing underneath it. The second person I will call Frances, 66, and she is not richer than Walter and not smarter about economics. She simply reads past the headline. When she saw that three members had broken ranks and demanded a hike, she understood immediately that this was the real news, that a fracturing Fed signals rising uncertainty, and that uncertainty is precisely the environment her gold was meant to protect against. But here is the deeper thing about Frances. She did not panic at the news, and she did not rush to trade on it, because the reason she owns her gold does not rest on any single meeting. She reads the dissent to understand the weather, not because it changes the reason she built her shelter. The difference between Walter and Frances is not knowledge. It is the discipline to look past the loud headline to the quiet signal beneath it, and the calm to hold steady once she has. Now, why is it so hard to be Frances and so easy to be Walter? The answer is not weakness. It is biology, and understanding it is one of the most useful things I can give you today. When you own something and news arrives that might move its price, the part of your brain that processes physical threat, the same ancient machinery that once helped your ancestors survive a predator, fires off before the rational, thinking part of your brain can catch up. A Fed announcement does not register in your body as an abstract policy event. It registers as danger or as relief. And either way, your body reacts with a flood of chemistry that pushes you toward a snap judgment, toward reading the simple headline and moving on, rather than doing the harder work of understanding what actually happened. This is why so many people miss the signal beneath the noise. Because the mind craves a simple, fast answer, and the headline gives it one. The investors who thrive are the ones who have trained themselves to pause, to look past the obvious, and to ask what the loud story is hiding. Today, the loud story is that nothing happened. The quiet truth is that the Fed just showed you it is at war with itself. And if you own silver, today's split hits you even harder than the gold holder, and almost nobody explains why. Silver carries a double sensitivity that gold lacks. When rate expectations shift, silver tends to move 2 to 3 times as much as gold in percentage terms, in both directions, because it is the more volatile, more energetic cousin. So a fracturing Fed, with its rising uncertainty about the rate path, will tend to whip silver around far more violently than gold. But silver has a second engine, gold does not, because more than half of all silver demand is industrial, physically consumed by solar panels, electronics, electric vehicles, and the data centers powering the artificial intelligence. Boom. That industrial hunger runs on a completely different clock than the Fed, a clock measured in years of building and manufacturing, and it does not care what the committee argued about today. So silver is pulled by 2 forces at once: the short-term rate drama that today's dissent inflames, and the long-term industrial demand that grinds on regardless. Understanding that silver is a different instrument, with sharper swings and a second engine underneath it, is the difference between being terrified by its volatility and understanding it. It is not simply a cheaper gold. It is its own animal, and a divided Fed will make it dance harder than anything else you own. Now, let me be honest and careful with you, because I will not insult you with fear. And this subject draws people who want to frighten you into acting. 3 dissents is significant, but it is not a catastrophe. And it does not guarantee that rates are about to soar, or that gold is about to crash or soar tomorrow. Central banks have disagreements. Dissents happen. It is possible the chairman reasserts control, calms the committee, and the whole thing settles into quiet. It is equally possible the split deepens and the pressure to hike wins out in the coming months. Anyone who tells you they know exactly which way this breaks is guessing and dressing the guess as knowledge, and they deserve your suspicion. What I am giving you is not a prediction. It is an understanding of what today's split actually signals, so that whatever comes next, you can read it calmly instead of reacting in a panic. Let me give you something practical. Then, a way to actually use what happened today. The next battleground is already set. Markets are now pricing in a strong chance, around 80%, that the Fed raises rates at its next meeting in September. Today's 3 dissents are a preview of that fight. So here is what to watch. If, in the coming weeks, the voices calling for a hike grow louder and more numerous, gold will likely feel that downward weight intensify in the short term. But if the economy weakens, if the job market cracks further, and the pressure shifts the other way toward holding or even cutting, that weight will begin to lift. Do not just watch what the Fed does. Watch how the committee splits, because the direction of that internal war is the leading edge of where rates and gold go next. And now that you know to watch it, you are ahead of the millions who will only ever read the headline. And here is the piece that puts all of this short-term drama in its proper place. The piece I most want you to carry away. While ordinary investors panic over each Fed meeting, watching gold fall and selling in fear, the largest and most sophisticated buyers on the planet, the central banks of entire nations, have been doing the exact opposite. They have been buying gold steadily, quarter after quarter, at a pace not seen in generations. They bought a net 244 tons in the first quarter of this year alone. And a recent survey found that the highest share in the survey's history expect to keep increasing their gold reserves in the year ahead. Think about what that means. The most informed money in the world is calmly accumulating the very metal that ordinary investors dump in fear over each Fed decision. They are not reading today's headline the way Walter is. They are buying for reasons that operate across decades, rooted in a world staggering under record debt, And a big part of why is exactly the kind of uncertainty you saw on display today, when the people steering the ship cannot agree on the course. The nations of the world quietly buy the one asset that does not depend on their competence. When you feel the urge to panic over a Fed meeting, remember who is on the other side of that trade, calmly buying what the frightened are selling, and ask yourself what they understand that the panicking crowd does not. There is a deeper force under all of this too, one that shapes how this must eventually resolve. And it is worth understanding. The United States government now carries a national debt of more than $39 trillion. And the interest bill on that debt alone has climbed past $1 trillion a year. Every time the Fed raises rates to fight inflation, it also makes that debt more expensive to service, blowing a bigger hole in the government's own budget. This is the trap. Beneath the trap, the hawks may want to raise rates forever to crush inflation, but the arithmetic of the debt makes that impossible to sustain. This is why so many sophisticated investors believe that whatever happens in any single meeting, the long-term direction must eventually bend toward looser money, toward tolerating a bit more inflation, toward a slowly weakening dollar, because keeping rates high forever on a mountain of debt like this simply cannot hold. And a slowly weakening dollar over the long run is precisely the environment in which gold has historically preserved value while paper money bled its away. Today's dissent is one skirmish in that vast slow war, and understanding the war is what lets you keep your nerve through any single battle in it. There is history here too, worth knowing, because it shows how this plays out over time. Go back to the 1970s, a decade of raging inflation and a Federal Reserve that was, for years, divided and hesitant about how hard to fight it. Through that period, gold did not rise in a straight line. It lurched, it corrected, it terrified people out of their positions again and again on the back of individual meetings and disagreements. And yet, across the full decade, it climbed from around $35 an ounce to over $800, an extraordinary rise precisely because the underlying disease, a loss of confidence in the management of paper money, never healed, no matter how many individual Fed meetings came and went. The lesson is not that history repeats exactly, because it never does. The lesson is that the daily noise of central bank drama, alarming as each episode feels in the moment, is very often just static laid over a much deeper and slower signal. The people who heard only the static sold and regretted it. The people who understood the signal held on. So let us pull it all together and go back to that crack that opened inside the Fed a few hours ago. The Federal Reserve held rates today exactly as expected, but 3 members broke ranks and demanded a hike, the clearest sign yet of a committee fracturing under pressure. That dissent matters far more than the hold, because a divided central bank signals rising uncertainty at the very top, and uncertainty is what gold responds to. The chairman, a hawk himself, who has refused even to reveal his own rate projection, is balancing on a wire between inflation on one side and a strained economy and a mountain of debt on the other. And today's split is proof of how badly that wire is shaking. The next battle is already set for September, where markets see a strong chance of a hike. And through all of it, far from the noise, the central banks of the world keep buying gold calmly for reasons that a single meeting cannot touch. So here is what I want you to carry away, framed as plainly as I know how. Today's news will move the price in the coming days, perhaps sharply, and neither I nor anyone else can tell you exactly which way. But the price moving is not the same as the reason for owning changing. If you hold gold and silver as protection against a world of staggering debt and uncertain money, then a single Fed meeting, however dramatic its internal split, does not alter that reason. If anything, a Fed openly at war with itself strengthens it. This does not mean you should ignore what happened, and it certainly does not mean you should pour your savings into metal in a panic, because volatility is real and stability matters, especially in retirement. It means you should read past the headline, understand what the dissent actually signals, and decide which time scale you are truly playing on, so that when the next shock hits, you are Francis and not Walter. The right decision depends entirely on your own circumstances, and I am not here to tell you what it is, only to make sure you meet what comes with understanding instead of fear. Do not let anyone use today's dissent to stampede you into a rushed move or a costly product, because they will try and they will grow louder. And equally, do not let the calm of the headline, "The Fed held rates," blind you to the alarm ringing quietly beneath it, or to what the most sophisticated institutions in the world are doing on the other side of the fear. Those are different errors, and the truth sits calmly between them. None of this is financial advice, and every fact I have cited to hold the three dissents, the September odds, the central bank buying the debt figure, is in the pinned comments so you can verify every word of it yourself rather than take mine. I opened by telling you the real story today was not the headline that the Fed held rates, but the crack that opened when 3 of its own members broke ranks. Now you understand why a divided Fed matters more to your gold than a united one, and why a chairman who will not reveal his own hand, presiding over a fracturing committee, has handed the market exactly the kind of uncertainty that gold was born to answer. So let me leave you with the question underneath all of it. When the people steering the ship stand up and start arguing about which way to turn, do you relax because the headline says they held course, like Walter? Or do you understand what that argument is really telling you, like Francis? The answer costs nothing to decide tonight, and it may be worth a great deal to have understood before the next meeting arrives.